Moving on. In terms of an overall breakup in the table, as you can see, revenues in Q1 came in at 1,930 crores. Overall, EBITDA from services came in at 196 crores, or 10.2% of revenue, compared to negative 0.3% for the same quarter last year and 11% in Q4, despite the fact that we've been expanding the network in Q1. Corporate overheads stood at 221 crores, largely driven by inflation in wages and an increase in some fixed costs of the network. As a percentage of revenue, they grew from 10.7% to 11.4%. And net adjusted EBITDA therefore came in at negative 25 crores, or negative 1.3%. To the next slide, yeah. Q4 financial, this is the EBITDA bridge that we present every quarter. Q4 financial 23 adjusted EBITDA stood at 6 crores. Our incremental revenue from Q4 to Q1 stood at 44 crores. And incremental gross profit in the transport business stood at 17 crores prior to certain specific items for Q1. We had about 4 crores of annual wage increments above the gross margin line, which is at the operational staff levels. We had planned investments in the last mile, which is the expansion of the delivery station network, which led to an increase of 2 crores and an impact of uncontrollable factors, which are linked to both security concerns in Manipur and the weather impact in North India in the second half of the quarter, which led to a decline by 4 crores. So the total increase in transport gross profit after adjusting for these stands at 7 crores. Transport fixed costs have increased by 13 crores, which is driven by an increase in mid-mile capacity, both in terms of gateway and hub infrastructure and in terms of the trucking network, and annual wage increases of supervisory employees, which is typically done in Q1 of the financial year. And we've seen a total decrease in transport service EBITDA, therefore, of 6 crores. Following this, there's an increase in service EBITDA. There's a reduction in service EBITDA of the non-transport businesses by 3 crores, largely driven by the supply chain services business. And secondly, an increase in corporate costs of about 21 crores, which is driven by increments in salaries of 6 crores, a one-time milestone-based payout to employees of TRI Robotics, which is a company that we acquired in financial 22 of 5 crores. Investments in our marketing program, which have begun this financial year, of about 3 crores, and provisioning for ongoing commercial disputes with certain vendors, in this case, Go Air, of about 2 crores, which leads to a total change of negative 30 crores and leads to Q1 financial 24 adjusted EBITDA of negative 25 crores. In terms of key cost drivers, as you can see, not very significant change between Q4 fiscal 23 and Q1 fiscal 24. Total freight handling and servicing costs have increased from 1372 crores to 1438 crores, which on an absolute basis continues to be below the same cost at the same time last year in Q1, which was 1453 crores. As a percentage of revenue from services, freight handling and servicing, therefore, is reduced from 83.2% last year to 74.5% as of Q1 fiscal 24. The major changes, one has been in vehicle rental expenses, which have reduced from 20.6% to 20.1%. We expect this to improve further as we continue to source intracity vehicles through our Orion platform. Contractual manpower expenses have increased from 11.1% temporarily to 12.1%. This is due to the impact of rains due to us continuing to pay salaries in states that have been affected by security reasons and annual wage increases. And overall, the net change otherwise is in lost shipment expenses, which continues to improve from 3.2% in Q1 financial 23 to 1.7% in the previous quarter to 1.3% in this quarter. Moving on, this is the final adjusted EBITDA bridge. Total revenue from customers, as I mentioned, stood at 1930 crores. Freight handling and servicing costs stood at 1438 crores. Employee benefit expenses of 353 crores. And other expenses at 152 crores, leading to a reported EBITDA of negative 13 crores. Adjusting for share-based payment expenses and capitalization of the leases, this leads to our overall adjusted EBITDA of negative 25 crores, or minus 1.3% of revenue. So to summarize the quarter, this is our fourth sequential quarter of revenue growth since Q1 of last year. Express and LTL businesses have demonstrated revenue growth and volume growth in a seasonally weak quarter, setting us up well for the rest of the financial year. Our capacity expansion plans have borne fruit in Q1. We've expanded mid-mile capacity and delivery center capacity in preparation for seasonal volumes in Q2, Q3, and Q4. Margins remain stable broadly overall, and we expect to have a great financial year ahead. With that, I'll pause and happy to take questions.
Thank you, Sahil. Just a reminder to participants, if you have any questions, please raise your hands and the operator will take them up. Thank you.
Hi, Sachin, you may ask your question now.
Sure. Congrats, Sahil and team on having a great quarter. I had a couple of questions. Basically, one regarding PTL business. So on PTL, we have been highlighting a weekly sort of trending in the past couple of quarters. I understand this was done due to spot-on acquisition, sort of integration issues getting over, and to reflect how we are ramping up. We do not see that happening this quarter. Do we assume that the growth in spot-on, PTL business has normalized now, or there is something else going on?
Not at all, Sachin. I think the point of demonstrating it in the past was really because there were several questions about the PTL business, and we felt it was necessary to demonstrate the ramp-up of volumes. As you can see, we've had a very strong start to the FY. We've seen an 8% growth in volume in Q1 over the previous quarter already, and compared to last year of 45%, 44% in overall volumes. And the idea was really simply at this point to say, look, integration issues are behind us, and going forward, we expect the trend of growth in PTL to continue. So we don't really need to demonstrate weekly volumes any further.
Understood. Quickly on the employee expense side, that's the second question. So I noticed that while our sort of employee expenses are going up very, very mutedly in terms of rising, but we see ESOPs being granted at a rapid pace, right? So in Q1, if I calculate quickly from the filings, roughly that amounts to 80 CR worth of ESOPs being granted. Is that how we should look at forecasting our ESOP expense in the sense like ESOP should grow, employees expenses in terms of cash being relatively muted?
Yeah, I think we've granted 2 million ESOPs as part of our annual performance cycle. Our annual performance cycle takes place at the end of Q4, and so the grants are made at the start of Q1. And then after that, we don't have too many grants which happen through the year except for some exceptional performance. So you're right, you will see ESOP expenses in Q1. Our policy is as per our performance policy. Wage increments, typically in our case, we forecast at being usually between 6 to 8% annually. But overall, you should not expect to see significant wage inflation year on year going forward.
Understood. Thanks. And just one final thing, I hope the violence in Gurgaon and the surroundings is not impacting business, or can you give some color on that?
Certainly. I think the reality is that both weather and security situations do disrupt operations in various ways. We haven't fortunately seen any significant impact on our operations overall. That said, with the shutdown of internet, even briefly, we had to modify how we were picking up and delivering consignments. We continued to remain operational throughout. We've also managed to continue to remain operational throughout in all rain-affected areas throughout the end of sort of Q1. So no major impact per se. We remained operational despite the internet connections. We've continued to pick up volumes overall. But we monitor the situation on 2 days, of course, where in particularly sort of violence-prone areas, we did have to suspend delivery operations briefly.
Understood. Thanks so much and all the best for the year ahead.
Thank you.
Next question for Sachin Sargamka.
Hi, thank you for the opportunity. I have 3 questions. First question, Sahil and team, just wanted to understand about what's happening on the ground on e-commerce as well as let's say from other operators like social commerce and D2C. Reason I'm asking is your shipment growth for 1Q was great, and just wanted to understand, should we look at this as a trend to continue? And, are we seeing, improvement in the overall general appetite out there?
Sure, Sachin. In general, these days, I'm quite careful when I'm making statements about the e-commerce market. But that said, I think, look, our volume growth has been solid in this quarter. We've been at 182 million shipments overall compared to 152 last year. I think if you remember, our position has consistently been that while the medium and long-term trajectory for e-commerce is consistent, we expect the market to grow between, call it 16 and 20%. And our growth has been at the upper end of that. Our assessment is that that represents an overall share gain in the market. In terms of market volumes, Q1 is historically not a very strong quarter for e-commerce. In general, Q2 is when the action starts picking up about now, and volumes then continue through Q3 and Q4. So we expect that hopefully there'll be sort of solid volume growth in August, and then with the Diwali sales at end of year. In terms of D2C, that's a particular segment of focus. I think we've gained significant share in the D2C market. Overall, we've been focusing on our value proposition for D2C, both increasing speed, integrating fulfillment, and launching a suite of data services, which a number of customers have now started taking up. And we've also been growing our presence in with smaller and the long tail of e-commerce, really, both with the launch of Delivery One, which is our self-serve portal, which allows small brands to really sort of access our services seamlessly. And also through the growth of our franchise network and the growth of our Delivery C2C shipping app, which allows the extreme long tail to start shipping through delivery immediately without sort of the burdens of a long contract process and a long sort of integration process. So that's sort of been the secret to our growth in Q1. I think we are optimistic about e-commerce as usual. Individual players, as I mentioned, and I think as is public, continue to face their sort of independent struggles, and their independent strategy continues to evolve. But for us, we maintain consistent market share with the larger players. We've gained share with the smaller players. We continue to launch value-added services. And so irrespective of market outcomes, I think we are well positioned.
Thanks, Sahil. So does that mean, you guys are seeing a mix shift more in D2C versus e-commerce in this seasonally slower Q1 for e-commerce?
We've certainly seen a shift in terms of client concentration. So our sort of top 5 client concentration is reduced overall. And both D2C, the definition of D2C is a little bit vague, but I'd say, sort of vertical e-commerce plus D2C plus SME is now a larger percentage of our business.
Thanks. My second question is on the supply chain business. And, historically, when we look at the growth, the trends look a bit volatile. Case in point, this quarter, we had a minus 13% YOY growth or a 10% QOQ growth. So just wanted to get a bit more color from you in terms of understanding what's going on here. And, we heard the comments in the opening mark about, you guys, getting a bit more marquee customers. Question out here is, should we see a stabilization of the trend out here, or, any color you could provide us in terms of how to look at this business?
Sure. I think as far as this business goes, Sachin, one of the things that we've spoken about is that the minimum size of this business actually is that sort of where it stabilizes is much larger than where we are. This is still sort of an early business for delivery. We have, these are typically large contracts that will be, anywhere from 20-30 crores a year at the minimum up to nearly 150 crores a year. And so, when individual clients' businesses sort of have their sort of moments in the year that can affect growth both upwards positively and negatively for us right now. I think there were disruptions in supply chain in general in Q1 when you consider the security situation, the rains, and sort of how it's affected consumption, and that's reflected a little bit in our numbers. The contracts that I pointed out, whether it's Havells or Tata Motors or Mamaearth or some of the others that are starting up, these are ones that we expect will begin in Q3, Q4. We've signed these contracts, and now we start deploying and building the infrastructure, which typically takes anywhere from about 60 to 90 days. So hopefully this will hit us in Q3 and Q4. But this business will continue to sort of, grow fast off of this base and see some volatility for the near future.
Thanks, Sahil. Very clear. And third question, perhaps to Amit. Amit, just wanted to understand what's happening in depreciation as well as other income. Depreciation was down 31% QOQ. Any one-offs out here? And same for other income. Is it all treasury income or something else out here?
So on the depreciation and amortization, there were two components, one related to depreciation of fixed assets. As you are aware that we basically build most of the capacity in first half of the fiscal year. So Q3 and Q4 typically see relatively lower investments. And as a result, the implication of lower WDV based depreciation is evident in the Q1 subsequently. So that is one of the reasons why depreciation and amortization, depreciation was lower. I think this number would tune to about 25 odd crore attributable to this. And on the amortization, in Q4 of FY23, we amortized fully the spot-on IT systems, which we no longer use. So that was an implication of another about 30 odd crores. In other income, there were two impacts. One was redeployment of our capital of about 5,500 odd crores into higher yielding instruments and mark-to-market gains. And other part of about 10 to 12 crore is a classification where we moved certain other expenses to, where certain adjustments were made between other income and other expenses. So that was a one-off item of 10 odd crore.
Thanks. So, just if I want to understand a bit more clarity on depreciation, amortization, going ahead, we should see some kind of a seasonality every year where 1Q is a bit low and then things start picking up 2Q onwards, right?
Yeah, this will a bit depend on when our, mega facilities come live. So this year we expect our Bhiwandi mega gateway to go live between September or November. And as a result, you will see the implication on depreciation in the subsequent quarters. Similarly, we expect our mega gateway in Bangalore to go live in March 2024. So you may not see the same impact that you are seeing this year in Q1 in the next year, Q1.
Got it. Thank you and all the best.
Thank you.
Next question, we go to Gaurav Rateria.
Am I audible?
Yeah, Gaurav, you are. Please go ahead.
Hey, I have three questions. The first one is we see PTL volume is 77% of what it was at the peak of 4Q on a combined basis. So is it fair to say that if we go back to that, our transport service EBITDA would also kind of revert back to a similar number what it was at that point in time?
Sure. I think that's a fair assumption in general, though our expectation and, we're still figuring out our line haul costs, for example, are coming in better than they were prior to the integration, which was, if you remember, the whole point of buying spot on, which was really essentially to be able to move more of the volume to larger automated gateways and through our trucking network. So potentially, at least internally, we would like the margins to be at least as much as they were at similar scale or higher.
Yeah, I was doing some rough maths, Sahil, on this. So if I continue to assume 50% incremental gross margins on transport business, then I get to a similar service EBITDA margin for transport, what it was at that point in time in the fourth quarter of fiscal 22. So does it mean that we still have scope for continuing to deliver more than 50% plus incremental gross margins till the time we get back to sort of a similar volume what it was at the peak?
So as I mentioned, in general, that would be true. But as I've said previously as well, it depends a little bit on the mix of the business in terms of exactly where it's coming from. At the moment, we do have pockets of underutilization which continue, relative underutilization, I would say, and therefore the incremental margin story continues to sort of be solid. That said, we are also discovering new ways of improving productivity, even in places which we had thought historically were sort of close to high utilization. Our engineering continues to deliver that. And so potentially this could continue slightly longer than we had previously expected. We're also discovering certain commercial benefits on the trucking side through our Orion platform. So the way to put this is that one would expect to get to at least the same margins that we had at the same scale. Also bear in mind one more thing, Gaurav, which is that we have been culling low margin customers and churning out some of these low margin customers or renegotiating pricing. So hopefully our expectation would be that even that will have some impact.
Got it. Secondly, on like once you get back to normal volumes or same volumes on a going forward basis, I think you kind of suggested in the past that incremental gross margins in this business should revert to more normalized level of 30%. How should one think about incremental service EBITDA margin in the transport business on a more normalized basis? Should it be between 20-25% incremental margin? Should it be lower? Just trying to understand the puts and takes there.
At this point, it's difficult to give exact commentary on sort of where the service EBITDA margins will be, but broadly, if you do the math, yes, I'd expect incremental service EBITDA margins to be in sort of that 18 to 22% kind of range.
Got it. Last question. I just want to understand a little better on your sourcing comment from your own Orion platform. How exactly did it help you and what incremental levers we have? Thank you.
Sure. Very simply put, Gaurav, it's essentially a freight exchange. Orion is a freight exchange. It was designed both for internal use cases for our line haul procurement, for our supply chain services business, and also externally for customers to place trucks through the platform. So think of it as similar to sort of what Full Truck Alliance does in China. Earlier, our line haul contracts were not being sourced via Orion. We continued to source them through our own fleet team. As we placed our line haul demand onto our Orion platform, we've had multiple vendors bidding for routes as we've opened them up. And as a consequence, we've seen commercial benefits come in as vendors have given us competitive bids, and we've had multiple vendors bidding. So that's been one reason. The second is that we've also expanded the scope slowly over the last year. We began by exposing our ad hoc or spot requirements of trucking onto the Orion platform. That was then expanded. The scope was expanded to fixed contracts as well. And so we started seeing benefits both on spot as well as fixed contracts. By way of context, spot contracts typically will be between 10 and 14% of our total trucking. 86% is fixed. So there were benefits that came in through that as well. And now we're also expanding this to intra-city movements, which is where we use a mix of LCVs and sort of smaller HCVs.
Got it. Thank you.
Next question we have from Sohan Joshi.
Hello, am I audible?
Yes, please go ahead.
Two questions, Sahil. Going ahead, what will be the impact on realizations? Because as you said in previous con call, individual players may have some ups and downs throughout this year going due to funding winter. And maybe some of our competitors are also raising funds like ShadowFax or ExpressBiz. So will it affect realizations in express parcel business going ahead?
No. Also, to be clear, Sohan, I pointed this out before. What happens to individual players or what happens to the fundraising strategies of other players in this market is not germane to our pricing strategy. Our stated ambition has always been to be the most efficient player in the market, which we are. When you combine the fact that we have an extremely attractive pricing proposition that we provide to all of our customers, irrespective of their size, coupled with the fact that we have the highest quality of service and we reach 18,530 pin codes, and we have the operating leverage that we do, I think, I don't think that any amount of capital raising or sort of pressures to individual players in e-commerce has any impact on pricing or market share for us. And the second thing is, if required, we will defend our market share because we have massive operating leverage and the operating margins to do so.
Okay, my second question is, in the previous con call, we had some talks about monetizing the IP of transition robotics. Are we through for that plan? I mean, we are going to see any revenue flowing from it in this year as well? Just can you throw some color on it?
Sure. We have begun to sort of road test our drones, as I'd mentioned in the last quarter. In fact, I think one of our models should now be commercially ready by Q3. That said, do bear in mind that there are licensing requirements and so on that we have to meet. And even if we were to have monetization this year, it won't be a significant portion of our overall revenues.
Okay, and just one question, if may I ask, any plans on acquisition on the table going ahead? Because there were media reports of Gati, there were media reports of you Delhivery entering into hyperlocal, though you have denied it in the BSE announcements, but still, any plans for acquiring any company which we can add to our networks? Any such plans?
So I think you answered your question. I mean, we already denied it. So after, it would be very strange if I were to announce something right now. But no, as I mentioned, we've denied it officially at this point in time. We're very happy with the organic growth opportunities that we have.
Okay. Thanks a lot, sir. That's it from my end. Thanks a lot. Good luck. Wish you good luck.
Thank you, sir.
Next question from Mukesh Sharaf.
Yeah, hi. Am I audible?
Yeah, Mukesh, please go ahead.
Yeah, hi. So firstly, if you could just quickly, give us the market share that, how the movement in your market share has been on the express business. Obviously, you've grown at close to 20%, but how the industry growth has been?
Mukesh, I think last time you put me on the spot with this as well. Look, we've grown 19% in volume terms versus last financial year.
Sure.
Now, various people measure market share in various forms, but our assessment is that market's grown at less than the 19% that we've grown at. And apart from that, we've seen significant increase in our overall volumes from D2C as a category, from vertical players, and from SME, which are three segments that generally are faster growing than the broader market. So our assessment, therefore, is that we've probably gained 1 or 2 percentage points on market share.
Great. Okay. And secondly, in terms of this increase in the fixed cost, like you mentioned, you're planning expansion for the year. So just understanding how much of that would have been done in 1Q. I mean, typically, say if you have to do X amount of expansion, 1Q covers how much of it? Would you have already done 70-80% of that, what you plan for the year in 1Q already?
More or less, Mukesh. The only sort of big expansion that will come in will be in Q3 when the Lonard facility in Bhiwandi goes live. That said, even that will not have a full impact on fixed costs because we're essentially consolidating infrastructure. So we operate our Bhiwandi gateway, we operate a large service station, we operate a large returns processing center, all of which are consolidated into the Lonard facility. So net, the impact on fixed costs actually will not be that significant even when Lonard goes live. In general, Q1 is where we would have committed and executed probably about 60-70% or sometimes even higher as percentage of our total capacity. Also, if you remember from the last call, I'd mentioned the 2 specific cities where we had expansion plans outside of Hyderabad, which was the other one, were going to be Chennai and Pune. And Chennai has gone live. So that's also been consolidated and is already reflected in our statements.
Sure. So we should, through the year now, the operating leverage should only play out as well.
Yes.
Right. And just lastly, very quickly, how would the debtor days differ for you across businesses? I think you had mentioned it once in the past, but if you could just recap that across businesses, how does that vary?
So can you repeat that question? You say the database?
The debtor days, the DSOs.
The DSOs. Amit, you have the exact statistics. Can you take this, please?
While we don't disclose the debtor days by line of business, we will formally give our debtor days in quarter at the end of Q2. But our analysis at end of Q1 showed that we have reduced debtor days on a whole of business by 2 days in Q1. And we expect the momentum to continue to bring down debtor days in
But very qualitatively, if you could tell me, Amit, on across these businesses,
so typically in B2C, the billing cycle is 30 days and the receivable days is also 30 days. So we bill by 2nd or 3rd of the month for the previous month. And then the bills become due by 4th, 5th of the subsequent month. We do not deduct the COD in hand from this debtor days. If we were to deduct we would be pretty much, zero working capital on express
Right.
business. But without that, we would be about a month odd, as you can see. In B2B businesses like LTL, supply chain services, FTL, the billing cycle being 30 days, the credit period terms could range from 30 to 60 days, and very exceptional contracts maybe 90 days.
Okay. Okay.
You can do the math on what the average would
Sure.
be
Sure.
in terms of the contract.
All right. All right. Great. Thanks a lot. I'll get back to you.
Thanks, Mukesh.
Next question we have for Hitesh Goel.
Thanks for taking my question and congrats on a good set of results. My first question is on when I see the the per shipment revenue for express parcel and both for PTL, it's actually on it's kind of declining for last 2 quarters. So is it a yield issue because you're saying the pricing in the market has not come down, so it's a mix issue? Can you just talk about that?
It's largely a mix issue, Hitesh. So it's a combination of both the client mix changing in the express parcel business, the salience of the heavy business as it changes. There is basically quarter on quarter, there may be variations in the overall yield, and also the zone mix. Typically in Q3 is when we see a bump up in realization, both because the salience of the heavy business can go up and slightly heavier products get shipped out in Q3. But per se, no change overall in pricing strategy between Q4 and Q1. So on express side, what you're seeing is really just a shift in mix to some extent.
And how?
Okay.
Sorry. Go ahead. You're saying something.
No, I was just going to answer the same question for PTL. Same thing on PTL. As I mentioned, it's a mix shift. In PTL, we sort of have three broad categories of customers. One is major accounts or enterprise customers. The second is SMEs, and the third is sort of retail and aggregator customers. As the mix across the three varies, there's a natural variance that sort of occurs in the overall yield. And outside of which, for specific customers, there are provisions that we take which can affect the yield in any given quarter, but no change in pricing strategy.
Sure. And my other two questions is, first is also on the network utilization. So how is it increased or decreased as you have set up more infrastructure over Q-on-Q basis?
The network utilization in Q1 is obviously slightly lower than network utilization in Q4 because we've expanded at an overall level, because we've expanded mid-mile facilities in preparation for the rest of the year. And obviously, we've increased the overall count of delivery stations also in preparation for the rest of the year. So utilization would have dropped a little bit to that extent. That said, at an aggregate level, network utilization doesn't really have any meaning because it's ultimately just an aggregate of utilization at each individual facility level. What I can tell you is that facility level utilizations for us in the mid-mile will typically vary anywhere from about 70% at the lower end to up to about 110% in various locations. And the delivery stations on average, my sense is that we are at this point probably close to about 60 to 65% utilized.
Okay. And you touch base bound on the PTL mix, right? So just want to get more sense on this. So what is your mix between enterprise, SME and retail? And when I compare the yield of other players in the market, the yield is much higher because I think the mix is also different because they're more towards SME or retail. So can you shed some light on it? How should we look at it? Because we are closely monitoring the yields to understand the profitability in the PTL business. Is that the right way to look at it?
It really depends. I mean, I can't really comment on what drives the yield for other players in the market. The way at least we look at it internally is our yield is determined by our own unit economics and our own targets in terms of gross margins and EBITDA margins. We do have obviously different pricing strategy for enterprise customers versus SMEs versus retail. And obviously the pricing strategy generally will be that the larger the customer, sort of marginally there are discounts on price. So retail will typically be highest yield, followed by SME, followed by major accounts. In terms of the mix, look, the reason I don't want to one is we don't disclose overall mix. And the second is at this point, providing sort of an exact breakup of mix is not a good indication of the future because Our ambition is not to grow at 5% a year. Our ambition ultimately is there's a $3 billion, $5 billion LTL market, and Delhivery at this point in time, all things said and done, we're a $200 to $250 million player. So there's a long way to go. Our ambition will be to gain share across all segments. We do not have a yield protection strategy. We have a growth strategy and a margin improvement strategy. And therefore, I don't think that our yield will remain absolutely sort of predictable going forward.
Okay, great. Thanks, Sahil, and all the best.
Thank you.
Next question we have for Pulkit Patni.
Yeah, actually, my question was also on yield. But the fact that you said that your focus is a growth strategy and not yield, I think it partly answers. Maybe just an extension of that. Q1FY22, your realization on the PTL business was close to 11,000, which has come down to 9,900 right now. And this is happening at a time when you said that you are taking out some of the low yield customers. So any rough math as to at what yield level do we think sort of we bottom out in the sense that we can't go below that? Any numbers that you have, based on the cost initiatives that you are undertaking?
Yeah, look, I think let's not confuse profitability and yield, because it is possible to be profitable. Let me give you an example. If you pick up a LTL freight in the city of Delhi and you're delivering LTL freight in Faridabad, the yield is naturally significantly lower than if you're picking it up in Delhi and delivering it in Cochin. And so, the overall yield that you have is a reflection of the mix of your business. So we don't, frankly, waste a lot of time comparing our yield to any of our other competitors. We have yield targets that we need to reach for every single load that we carry. And we have the systems which allow us to price every single load accurately. Typically players in this space have relied on sort of rule of thumb guidelines for yield, whereas we tend to take what we think is a more scientific and strategic sort of look at how to price for every load. So as we have culled low margin customers, that may or may not have any sort of implication in terms of yield remaining stable, going down or going up. You can have unprofitable customers at a 16 rupee yield, and you can have highly profitable customers at a 5 rupee yield. And our ambition, of course, is to have highly profitable customers at all yield points. So, that sort of, I don't know if that answers your question, but we don't really, there's no minimum yield also at an aggregated level that makes any sense. If it's a intra-city load, typically you would argue that sort of the minimum yield you require is about 5 rupees a consignment. And then, of course, it varies depending on the distance that you're traveling.
Sure. So effectively from 11,000 to 9,900, it's really not any discounts on real customer. That's just the mix that has been changing through this period, or things like distance, etc.
Absolutely.
Okay. Thank you.
Next question we have for Baiju Joshi.
Hi, am I audible?
Yeah, hi,
Hello.
Baiju, yes.
Yes, thank you. Thank you for the opportunity. I have two questions on behalf of Aditya Suresh, if I may. First question is on the small disruptions. Like last year, there were rains, and then again this year, there were a couple of incidents. So just wanted to understand what steps you can take at your end to tackle such disruptions so that these don't cascade into bigger issues.
It's a good question. We've called out before that one of the big macro risks that faces the company is disruption through weather. At our end, of course, we have a fairly rigorous process of making sure that our infrastructure, especially the spine infrastructure, is resistant to all forms of natural calamities, including rain. So our facilities are designed as such, right? From vehicle ingress to parking to making sure we have staff which is available and taken care of, to health and safety measures. So we've seen per se no major disruption in our spine network in terms of the ability to service our customers. That said, customers obviously do face disruptions in their operations when it's raining heavily, and as a consequence of that, sometimes that may lead to either a pile-up of volumes, which means too much volume, and in some situations, customer operations may be shut. There's limited sort of control that we have on that. But if your question is the network managed to be resistant to rain? The answer is yes.
Thank you. And secondly, can you provide any update on the ONDC network and any use cases that have seen considerable traction in terms of volumes?
See, we're not yet significant participants on the ONDC network. I think ONDC has seen some traction, especially on the food side. I'm not aware of sort of what the most recent numbers are, but the last I'd heard numbers were in the range of weekend orders of food were in the range of some 30,000-40,000 orders a day. Look, whenever ONDC plays out, we will be meaningful participants as required. I think we like the idea that we have the ability to publish a price and a service level. We also have both the staffing, the technology, sort of the underlying cost advantage to service any demand on ONDC. We are integrated. We continue to watch it, but at this point, we're not active participants.
Understood. Thank you very much.
Next question we have for Ankita Shah.
Hello. Yeah. Can you hear me?
Yes, Ankita, please go
Yes.
ahead.
Hi. Sir, you shared the approximate utilization level on the mid-mile side, but on the first and last mile, would it be possible for you to give some color on the utilization side?
Yeah, utilization on the last mile, as I mentioned, Ankita, is in the range of about 60 to 65% of theoretical capacity. That said, even in the mid mile and in the last mile, I do want to point out that one of the jobs that our engineering teams perform is to continuously figure out how we can release additional capacity. So the 110% in the mid mile also that I pointed out, the reality is that we probably have the ability to go to 120, 125% with better engineering, which we continue to explore. So like I said, I wouldn't read too much into aggregate utilizations across the network at this point in time. The way I would put it is there's operating leverage in the business, which is quite evident. I think we've spoken about it multiple times over the last several quarters. And the second is that, as you're aware, at the gross margin level, our unit economics continue to be highly positive. And so overall, as utilization, even if it stays flat, volume growth should deliver returns to us. And if we continue to sort of see these, engineering opportunities to increase productivity, we'll see an improvement in margins. But there is a reason we do not publish aggregate network utilization. I'm aware that other players in the industry once in a while do provide this estimate, but in our view, providing a network level utilization actually is dangerous and false.
Okay, noted. Secondly, just one clarification. Is there a change in the number of 1Q23, same quarter last year, volume numbers of PTL business? Because I think we've published 239,000 this quarter, and the earlier presentation was mentioning 262,000 tons. So just wanted to clarify, or I can take it offline if at all.
I will ask Amit to just investigate that and come back to you, but per se, there's no change.
Okay, I'll get that checked. Secondly, last question from my side. So in last 2-3 years, if I look at the annual numbers, there was a increase in the lost shipments number. I have seen on a quarter-on-quarter basis for 1Q this has come down, but on a full year basis, any outlook on where this number can be on a yearly basis, full year FY24?
So as you can see, the total loss and damage expense as a percentage of revenue is at 1.3% in this quarter. We did see a spike in Q1 when we had integration issues, and this was more reconciliation sort of related loss and damages that we had to bear in Q1. On a normalized basis, our expectation is that loss and damage should be sub 1% of revenue, and that's the internal target that we're working towards.
Okay. Thank you.
Next question we have from Srinidhi.
Yeah, hi, am I audible?
Yeah, hi Srinidhi, go ahead.
Yeah, hi, Sahil. Thank you. Congratulations on good set of numbers. Sahil, I want to understand on the operational strategy wherein we are basically integrating mid-mile operation of express business and PTL business. In that context, does company have to be very selective in terms of what load it picks from the PTL customers?
I think irrespective of our strategy of integration, we have to be selective about the kinds of loads that we pick from customers. Our view has been very simple, which is that we look for loads fundamentally, let me put it this way, we do not do loads that are not easily transportable. So as an example, we don't do over-dimensional cargo, we don't do hazardous material, we don't do improperly packaged material or loosely packaged material in the PTL network at all. It's a fairly tightly controlled sort of form factor, and we don't do loads where a single piece weight is higher than 400 kilograms.
But these are like more of a specialized cargo, right? Rest of the market itself should be very large, which could be integratable, right?
Absolutely.
Okay. And does the load characteristics also matter? Like if it is very seasonal, your network can't handle it. And is the load coming from a smaller customer? Do you have a more of a marketing bandwidth to handle it, or it doesn't matter whether a customer is small or the load profile through the seasonality is very different?
The whole point of delivery is that essentially we are able to service any size of customer with any form of load that fits our requirements. As I mentioned, there are a small set of things that we don't do, but outside of that, irrespective of a customer's seasonal requirements or a customer's sort of size, we provide exactly the same service. In fact, we not only provide it's not only our ability to serve, our aim really is to be the lowest cost service provider for absolutely any size of customer and to be the highest quality service provider to any size of customers. So we do not differentiate in terms of either, sort of saying we can't handle your loads because of seasonality, or we can't handle your loads because you're a small customer or anything of the sort. Our entire network is designed to service everyone.
Yeah, thank you, Sahil. And one more, if I may. In one of the presentation deck, you highlighted of incremental investment in marketing. It is directed more to adding SME customers in the PTL business with your network getting stabilized and service level back to the level you want?
That's exactly correct. We have no particular need to perform marketing for our e-commerce business. We're already the market leader. And I think we're more or less the default choice for anyone. And on the PTL side, I think what we're doing is expanding our local presence across tier 2 and tier 3 markets across the country.
Thank you, Sahil. Those were my questions. All the best.
Thank you very much.
Next question we have for Aditya Mongia.
Hi, everyone. I think the first question that I had was more on the adjusted EBITDA margins that you reported in the first quarter. Right now, I see this is a 200 basis points improvement over FY22. What I wanted to understand was that should we assume that FY22 was a good reflection of seasonality across quarters, and thus the full year FY24 numbers should be 200 basis points higher and probably even more so given the cost improvements that have happened in this period?
So Aditya, you're breaking up a little bit, but I think I got the gist of your question. I think, far be it for me to suggest what you should or should not assume. But broadly, what I can certainly tell you is that, yes, our margins in FY24 are 200 basis points better than they were in fiscal 22 on a larger network as well and on lower realizations. So that should give you a sense of sort of the operating leverage in the business. I do think there are certain structural factors in fiscal 24 which are, better than fiscal 22. One is sorry, go ahead.
The second question that I had was more. Can you hear me?
Yeah, Aditya, I can hear you, but I think you missed my answer, which is fine. So why don't you go ahead?
Yes, if you can hear me well, the question that I had was more on the recent announcement by Flipkart to enter the express B2B space. The question that I had was, do you think that given the benefits of being inside Express B2B as a synergistic step along with B2C, these kind of strategic actions would happen more and more by almost all e-commerce players? And obviously, if that is the case, does that make us more worried about us kind of retaining this competitive advantage over time?
Sure. Aditya, can you hear me? Just checking.
I can hear you well, yeah.
All right. I'll answer the question, but I think there's some background noise, so maybe you can. Yeah, okay. I think Aditya's question was essentially, are we worried about the fact that Flipkart has decided to get into B2B logistics? The short answer to this is no. And fundamentally for a couple of reasons. One, very, very simply is that fundamentally the PTL model that you require to establish, it needs to have a distributed network of our kind, which in our belief, self networks do not have. And so their ability to scale up their B2B businesses is uncertain. The second is, I don't see any strategic advantage or strategic rationale for captives to be in this business at all. First of all, it doesn't make any sense for a captive whose job is to provide theoretically a higher customer experience to the e-commerce brand going out and, let's say, delivering spare parts for Tata Motors to their dealers. I mean, I don't understand what the logic for that is at all and how this is capital efficient whatsoever. So there's a strategic misalignment, there's an economic misalignment, there's an executional misalignment. I think making an announcement is the easiest part of setting up a business. So the rest of it we'll see. But per se, if your question is, are we worried? The short answer is no. We have the infrastructure, we have the capability, we have the team, and we have the economics to continue to grow in this market, irrespective of individual strategies by the captives.
Just a last question from my side. Your 4Q adjusted EBITDA numbers for FY22, which were 3.5% on the positive side, were they stable numbers for a fourth quarter, or did they have any choppy scale-up driven?
Yeah, if you were to look at quarter three was also positive when the influence of Shopee was not as large. So yes, there was some impact from Shopee, but it was not as significant perhaps as you think. Outside of which, as I mentioned, there are structural factors in our business in this financial year which are different from where we were in financial 22. We have larger, higher scale hubs which are more automated, higher productivities. And we also have a significantly more developed trucking network, and we've also been jettisoning low margin customers. So let us see as the business plays out. Financial 22 was a good indication of how operating leverage in our business plays out. But neither financial 22 nor financial 24 is going to reflect exactly what the long-term economics of the business are going to look like.
Thank you for those answers. Those are my questions.
Thank you.
Next question we have from Rishabh Pare.
Hi, can you hear me?
Yes, please go ahead, Rishabh.
Sahil, just one question on our, incrementally we've guided that our gross margin will be 50% of our incremental transport revenue. This quarter is about 38%. So what would you attribute that to? And going forward, do you think we can hit the 50% mark over the next 3-4 quarters? Thanks.
Thanks, Rishabh. Yeah, that's a good point. I think we would probably have ended up at the 50% mark in any case. I think there was some volatility which came from weather towards the end. One of the things it does is it reduces last mile productivity to some extent because the number of deliveries per person comes down, obviously because of the impact of the rains. That's one of the reasons why incremental gross margins in this quarter look a little softer than they have in the past. How much further will the 50% incremental GMs continue? As I mentioned, this question's been asked quarter on quarter. When we began in Q2 last year answering this question, at that point, our estimation was that it would last till Q4. But, we've been pleasantly surprised that incremental GMs have continued to remain high in Q4 and in Q1. And as of now, I do think that we have, sort of capacity in the network, and our engineering is strong enough to allow us to continue to see high incremental gross margins in the near future. Long term, our expectation, of course, when capacity utilization normalizes, is that incremental gross margins will be in the 30 to 35% kind of range. But whether we'll be there exactly sort of in this quarter or the next quarter or the quarter after is not something I can immediately comment on.
Understood. Thank you. Thank you very much.
Next question we have from Naitik Modi.
Yes, hi, thanks for the opportunity. Can you hear me?
Yes, absolutely. Please go ahead, Natik.
Yeah, Sahil, again, my question on the PTL business. So the incremental business this quarter on quarter has come at a much lower realization. So just wanted some understanding on that.
Yeah, as I mentioned, I think this is a combination. This is a mix impact and also an impact of what lanes we're servicing. As I mentioned, the three major segments of the business are major accounts, SME, and retail. So one is this automatically sort of as the mix of those customers changes, yield may change a little bit. The second is within those customers, obviously, as they expand their relationships with us, it's possible that they're shipping on some lanes which are shorter distance lanes, for instance, therefore affecting yield. I wouldn't look at yield necessarily. Internally, what we look at is gross margin for the PTL business and EBITDA for the PTL business. As long as those are trending upwards, on an absolute and relative basis, we don't have to worry about changes in yield. If your question is, has there been any change in pricing? The answer is no.
Okay, thanks. And on the service EBITDA, we have made about 197. Of that, how much losses would be there in the non-transportation business?
Amit, do you want to take that question?
Can you please repeat the question?
So out of the service EBITDA that we've reported about 197, this would consist of what losses from the non-transportation business?
The service EBITDA of non-transportation businesses would put together be almost flat or about like 2 percentage points.
Oh, okay. All right. Fine. Thank you.
Next question we have for Mayo Gatani.
Thank you for the opportunity. I just wanted to check, you mentioned something on the SaaS in the presentation. Maybe I missed it. Can you throw some more light on what that was and what are you referring to? First question. And second was, you've been very confident on the margin front, on the volume front. And but the margins have been on the weaker side because you have increments this quarter, you have some one-off expenses for expansion that you're expecting a lot of growth in the second half. So this will continue in quarter two, or this is what you have to do, and now you will see a significant improvement in margins as volumes increase.
Sure, Maya, let me answer the second question quickly because that's a much shorter answer. As you can see, in every year, margins begin to improve in quarter two, and that continues through the financial year. Our wage increments obviously hit us in quarter one. And as I mentioned during the question from Mukesh Saraf, we typically see about 60 to 70% of our planned infrastructure development to happen in quarter one. So no, I don't expect any significant increase in the fixed cost base going forward in Q2, Q3, Q4. We do expect volumes to grow through the rest of the financial year. And so the operating leverage should play out and margins should improve as volume growth kicks in. Obviously, bear in mind that quarter three, quarter four are seasonally high quarters, both for e-commerce as well as for PTL. Coming to your first question on platform and Dispatch One, as I've mentioned multiple times, OS1 is the platform that we've been building for the last 3.5 years. It's essentially, think of it as building Android for logistics, effectively an operating system which allows logistics operators, enterprises to essentially build their own logistics applications and also to integrate with the deliveries logistics systems. It's aimed at small-scale operators both in India and the rest of the world. They have the ability to use our first-party applications, which is Dispatch One is one example of that, which we've launched, which allows last-mile operators to essentially use our dispatch service. So it's exactly the same as Delhivery's dispatch service. And they also have the ability to customize it to their specific needs in case they have sort of highly specific product requirements. This is aimed at companies both in India and outside India. So we're going to be targeting both the Middle East and the US as potential customers. We have 10 potential customers that we're speaking to. It'll be monetized similar to a standard SaaS product. But that said, this isn't going to be a significant portion of our revenues at all through this year. We're still at an early deployment stage. So first-party software is one part of what we're doing, which is the SaaS product. The second is also allowing other logistics applications to ride on top of our platform. So you will remember that we acquired a company called Algorithm, which provides data services in the supply chain services space. So that will also be deployable on top of our platform stack. And similarly, other, for example, routing applications or scheduling applications can also be deployed on top of the OS1 stack, which will then be available to all of the customers who delivery services. So that's broadly the platform strategy. This is the first commercial deployment that we're doing. It's on schedule as of now. We don't expect it to form any significant portion of revenue or profits in this year. Hopefully, we'll start seeing monetization slightly more significantly in the next financial.
So just to understand better, you are saying that you've developed a platform on the delivery basis where a third-party logistic company can take it from you and run their own business in India as well as outside.
That's right. They can use both our first-party applications, or they can use components of the platform to build their own logistics applications as well, if they happen to have the resources to do so. We provide them the basic libraries, the basic toolkits that they need to do so, and also the configuration layers if they need to do so. So let's say you're a large logistics company, you can use the base components of platform to build your own logistics applications. Let's say you're a small logistics company and you want a first-party dispatch application, we'll provide it to you. Let's say you're a logistics SaaS company which wants to offer your services to customers who are using Delhivery's logistics stack, you can do that as well. So that's broadly what platform is.
Sorry, just to ponder a little bit more on this. So will it be like, why would someone use your software? Because wouldn't it be leading, giving their information, their client information to you?
No, the data, it's similar to how you would use, as an example, AWS. Data jurisdiction is very clear. Delhivery does not have access to proprietary data. This is entirely all of the data belongs to the specific company which is utilizing our services, and we have no access to it.
Okay, and we see a better monetization or numbers coming from FY25 onward. This is just the start.
Yes.
Thank you, and all the very best.
Thank you.
Next question we have from Keshav Bagri.
Hello. Hi, sir. Am I audible?
Yes, Keshav, please go ahead.
Sahil, my question is more from a business perspective. Like we strive to offer the best services at the best price. But don't you think that price should command a premium in the market? And if we are not focusing much on the pricing part of the picture, then how are cost efficiencies lying? Because I think that there's a lot of infrastructure integration which we have done with Spot on. So if you could just explain me this.
Certainly, Keshav. It's not necessary that the best product should always be the most expensive product. If that were the case, as an example, cloud computing would have died at the start. The fact is that certain businesses are the plumbing of how other businesses work, and logistics is one of those. If your payment gateway said we are the highest quality payment gateway and therefore you should pay us the highest charges, there'd be no electronic payments. And our view is that logistics is more or less exactly the same. You must remember that ultimately, and we remember, our stated strategy is that we are a cost input to all of our customers. Every dollar that we save our customers is a dollar that they get to invest in growing their businesses. And every dollar that they invest in growing their businesses is ultimately a dollar of revenue that comes back to us and allows us to scale further. Delhivery's stated strategy has always been and will always be to be the most efficient and lowest cost provider of services to all of our customers and all of our business lines. In fact, I think the big fallacy in logistics has always been the desire to be a high-price yield management. I think there are specific verticals where that makes sense. If you were delivering vaccines, certainly being a premium player would make sense. If you were running cold chain, perhaps. But what we do fundamentally is high scale, and we are a cost input to highly cost-sensitive customers, and we therefore have to be the lowest cost service provider.
That works. And my second point would be on the warehousing space. Like, what are we offering there? Because I think Safe Express has released their annual statements and they have touched around 3,000 crore revenue in the express parcels, and they were very bullish about the warehousing space. So I just wanted to understand what is Delhivery proposing in that space.
We provide fulfillment centers both for B2C commerce as well as for B2B. It's essentially an integrated supply chain solution. So let's say you're an e-commerce company or D2C company, which requires warehousing space for your inventory across the country. We provide it on a variable basis so that you don't have to invest upfront in the fixed costs of warehousing. We also allow you to distribute your inventory across the country and essentially allow you to create a white labeled Amazon Prime kind of service. On the B2B side, it's an integrated supply chain solution. So essentially, we help companies design and execute their supply chains. We both obviously help them store inventory and transport inventory to and from plants and warehouses across the country, and then to dealers or to customers. And through algorithm and through Vinculum, we also have the ability to help them optimize inventory placement and fill rates and transport selection. So warehousing obviously is sort of knit into the whole supply chain services and transportation ecosystem.
So continuing my point on business ideology, I just wanted to ask, how far are we from volumes which would help us realize EBITDA level profitability? Because I think we are doing good as far as PTL volumes are concerned. I think we have reached a significant, I would say, stage of saturation of the service levels. So how far are we from the volumes? So could you please just...
Certainly, Keshav. I think if you look at Q4, you can see that we had a bit of break-even in Q4. And so our estimation is that this year we will have quarters where we will break even. So clearly, we're not far from volumes being large enough for us to be break even at an adjusted EBITDA level. Our ambition, as I mentioned in the past, is also to be generating net profits by the time we are late financial 25, early financial 26. Over the next couple of quarters, though, do bear in mind the market is very large. It's, India is anomalous as a market in terms of the fact that we don't have a single large logistics company. As India's largest integrated service provider, we are, as of last year, we were less than $1 billion in revenue. I think our focus really, first of all, is also to grow in size, which is really to be a $5, $7, $10 billion company in revenue terms. And so in the short term, as we continue to make capacity investments in any single quarter, our adjusted EBITDA margins or our PAT margins may be negative if we expand capacity heavily. This is based on our assessment of future growth. But this year, again, as we've seen in financial 22 and in financial 23, I think operating leverage will kick in and we will see profitable quarters this year as well.
And my last question would be on the competitive side. I think Marsec has also announced that it is entering the express parcel business with a flat rate of some 80 rupees per some parcel and all. Plus, there's a lot of cash on the balance sheet. And I know the proceeds have just begun, like has just come 18 months back. So how are we planning to use that? Is it more on the acquisition side, or are we going to add more trucks and more physical facilities? So could you please just...
Sure. I think for us, strategically, we've always been clear, which is we will continue to build capacity to service the market, which means expanding our mid-mile facilities, which means expanding our trucking network, continuing to gain scale. And so a portion of the cash that we've raised at the moment will continue to be invested in expanding capacity. We obviously believe that we are a natural consolidator in this market. And, we do look for inorganic opportunities for growth as well. And so, a certain amount of our capital, should we find the right asset at the right price, will be deployed towards acquisitions if required. We made a couple of bolt-on acquisitions on the tech side in any case over the last couple of quarters. And outside of that, some of it, is also ultimately within a volatile and uncertain world. And so it provides a buffer of safety to the company. Having a strong balance sheet, I think, is also a competitive advantage to us. About Musk, specifically, I can't really comment too much because I have no idea why an ocean freight company wishes to compete in an express parcel market. But I doubt that it's likely to be a very successful strategy, at least in the short to mid-term. It's an entirely new capability for them. And if you ask me, the 80 rupee price point is higher than the price point that players in the market, not just Delhivery, but other players in the market already offer. So I'm not really sure what the value proposition is at all.
Thank you. That is great.
Next, we have Dirish Pathak.
Hello, am I audible?
Yeah, hi Dirish, you are. Please go ahead.
Hi, thank you for taking my question. This slide which is there on ESOP charge. So this year's comp cycle, if I heard correctly, you said is already over, and this year you gave 2 million ESOPs. right?
That's correct.
Okay. And what was this number last year?
Amit, can you take this question, please?
I'll just pull in the last quarter's results and share.
No, so my basic question was, where I was getting to was that on a steady state basis, like you share, right? In a steady state, we'll have 30-35% gross margin. So what is a steady state ESOP charge? Because in this table, as of now, FY28 shows 0, right? But as time passes, you have grants being done. So on a steady state basis, what is going to be the ESOP P&L charge?
Yeah. Apar, can you please jump to that slide? So I'll just summarize how our ESOPs are structured. There are two portions of our stock options, performance-based and time-based. Can you go to the previous slide, please? Yeah. The ESOPs which are ungranted today stand at a total of about 39 million stock options, out of which time-based are 24 million stock options, and performance-based are almost 15 million stock options. These performance-based stock options vest at a share price level of 800 rupees a share, 1000 rupees a share, and 1200 rupees a share. The charge for the performance-based stock options granted has been shared separately from the charge based on the time-based stock options. The performance-based, the grant of the 2 million stock options that happened this quarter was of the time-based stock options, and correspondingly the charge would be close to about 80 crore rupees for the full year. So as you can see, if we were to use somewhere around, let's say, 3 million stock options a year on time-based, the 3 to 4 million, the pool would last about 6 to 8 years for us. And equally, if we were to use about 2 million performance-based stock options per year, again the pool would last an average of about 7 years.
Mm-hmm. Understood. So on average, you're giving 2 to 3 million ESOPs per year, and these are given at face value, right?
Yes, 2 to 3. I mean, I said that roughly you should assume that 3 million odd time-based stock options per year, and about 2.5 to 2.5 million performance-based stock options. The performance-based stock options costing gets adjusted downward because of the probabilistic event of achieving these share prices. Yeah, and just for accounting standpoint, this cost doesn't get reversed in accounts if the price level is not met, and equally there will be no dilution corresponding to these either.
Understood. And coming to this slide 11, which is on the incremental adjusted EBITDA movement. Now, some of the costs are related to capacity expansion, but if we take out some of those, for example, DC capacity expansion was 2 crores. Then there is 13 crore increase in transport fixed cost. Some of that is mid-mile capacity investment, and some of it is business as usual increases in salary. So my point is that even if we take out some of the costs which are related to capacity expansion, then the increase in transportation service EBITDA, corresponding to the increase in transport revenue. Obviously, you have not given the breakup. First of all, if you can give the breakup. So for example, 2 crore I can clearly take out and add back to the -6, right? But out of this 13, how much is mid-mile capacity expansion?
So the way I think one other important part to look here is the security and extreme weather related impact. This has been estimated at a conservative level where parts of the country have been completely completely shut, and our estimate is that we would have lost about 500,000 to 1 million package volume in this period, and we continue to pay wages for all our staff and ensure their security. So if you were to take, just add 2 and 4, this will take it, this will make the service EBITDA impact neutral, and the mid-mile capacity expansion would have been, I think, about 8 to 9 crore out of that 13 odd crore impact here. So that
8
would
to
be
9. So we add another 4. So basically on 44 crores of incremental revenue, adjusted for all these things, you have 4 crore increase in
no,
transport
you would
service
add
EBITDA.
8. You would add back 2, you would add back 4 from the security cut, and you would add back
Correct.
8 from the mid-mile capacity.
Okay.
That.
Okay. So then you have these increase in corporate cost also. So in this, there is only thing which is one-off seems to be this 5 crore, one-time milestone-based payment. So net, the costs are also increasing, and the increase in service EBITDA is not able to take care of at that scale that we are operating in.
This
Somehow,
quarter.
In this quarter.
This quarter, I think the point that we've been making consistently is that these are in preparation for larger volumes going forward. I wouldn't read too much into the numbers from any single quarter.
No, but then the adjustment that we are doing was to take out those costs, right, which are arising because of the scale investment. And then after making those adjustments, then we are saying that increase in corporate cost are not able to take care of the increase in transport service EBITDA after having made the adjustments for scale investments.
I'm sorry, the increase in corporate costs of 6 crores in salaries is an increase linked to our annual performance. We have an incremental revenue of 44 crores. The incremental gross profit is 17 crores, which is quite obviously visible. There are certain network investments that have been made because we expect significant incremental revenues through the rest of the year, which will come through. Our corporate costs are not expected to rise through the rest of the year. The remaining fixed costs are not expected to rise through the rest of the year.
Understood. Okay, thank you for explaining.
Hi. We're at the end of the Q&A, so Sahil, Amit, I'll just jump in with a few questions from my side, if that's okay. Yeah. So one of the things you mentioned, Sahil, in your earlier presentation also is that you've closed some of the partner constellation last mile centers, opened new express delivery centers of your own, and you mentioned that the larger partner centers were moved in-house. So I'm just wondering, is this driven by, as partner centers become larger, there's scope for deployment of automation, and you do prefer to do that in-house? Is that how I should think about it? Or is this a one-off thing, or is it a structural change in that sense?
It's a tactical thing that we keep doing on a regular basis. These are small delivery stations.
Right.
The constellation program is where somebody in a local market can run a delivery station for us. It's not because there's scope to automate or anything of the sort. I think when volumes become large, typically there are certain processes that need to be built in, which are better done through our own delivery centers than through partner centers. Partners may continue with us. What typically happens is that you split the network. So, for example, if you're running a telecom network, as traffic in a cell site becomes larger, you split the cell site. Similarly, in logistics, when the volume in our DC becomes large enough, we split the DC. Or we replace it with one of ours. It's a fairly tactical and sort of routine process.
Got it. Understood, Sahil. My next questions are just some housekeeping questions. So first, if you can explain what you meant, Amit, on some changes to other expenses and other income, because I noticed that the other expenses also went up QOQ. So if you can explain that. And then finally, you used to provide this cash lease rental split between interest expense and ROU. So if you can do that. And finally, the CapEx and FCF for the quarter, and related to that, did working capital kind of benefit from the higher share of D2C in this quarter?
So, Vijit, I won't have the CapEx and FCF number exactly with me, but the working capital improvement was largely driven from our B2B businesses, primarily part truckload and supply chain services. The CapEx and FCF numbers we will release along with our September balance sheet. Coming to your ROU question, can you, Apar, please jump to the adjusted EBITDA bridge slide? We again may not have the ROU absolute asset here because the balance sheet was not been released for quarter one.
I see.
The adjusted EBITDA walk car. Yeah, so the actual rent paid for the quarter was 66 crore.
Yeah.
While your amortization of the rentals would have been part of the depreciation and amortization. We'll share back this exact number along, offline with you.
Okay, sure. And yes, so just the last question, the clarification on other expenses and other income that you mentioned earlier. What exactly?
Take this up. Varun, can you please take up the adjustment between other expenses and other income adjustment?
Can you please repeat the question? Can you please repeat the question?
The adjustment that we have done in other expenses and other income. It is a classification. What exactly was reclassified?
Hi, Vijit, can you repeat the question, please?
Yeah, Varun, can you hear me? Hello, Varun. I think I think Amit, Varun can't hear us. Varun, if you can hear me now, the question was.
I can hear you now.
Okay. The question was, what is the reclassification that has happened between other expenses and other income? Because the other expenses look like they've gone up QOQ, right? So
the increase in other expenses is not driven by the reclassification. Some of the expenses that would have that drive this increase in other expenses are, if you see the notes that we have disclosed as part of our annual results earlier, you'll see that marketing expenses are a part of our other expenses.
Okay.
Some of the things like travel expenses are part of our other expenses, or things like the technology costs are part of our other expenses. So these costs, technology costs, would have gone up along with volumes as well as the fresh investments that we make. On that bridge slide, you would have seen that we have shown as part of our corporate cost increase that we have increased our spends on marketing starting this fiscal. But that also explains the increase in other expenses. So it's those kind of multiple items which have driven the increase in other expenses. A majority of them would be part of our corporate costs.
got it. Thank you. Those were my questions. Thank you so much. I think we are at the end of this call now. So I'll just give this back to Sahil and team for your closing remarks.
Thanks, Vijit. Thank you all for joining the call. And as I mentioned, the summary of the quarter is, we're happy to have a fourth consecutive quarter of revenue growth. We made some investments in capacity expansion, which have marginally reduced margins, but overall economic performance of the business continues to remain stable. And I think we're pretty positive growth outlook going into Q2 and the second half of this year. And so hopefully see you all at the next earnings call in 3 months. Thank you for hosting us, City team.
Thank you. Thank you, everyone.
Thanks, everyone.